In our last video, we showed you exactly why FTMO removed the 200,000 swing account and why swing trading gives you a structural edge over every other approach when attempting a funded challenge. Today, we are going to deliver on the promise we made at the end of that video. We are going to show you the exact swing trading framework we use to approach prop firm challenges, the time frames, the instruments, the setup criteria, and the risk management rules that keep you inside the drawdown limits while still hitting the profit targets fast enough to matter. And we are going to cover something that most trading educators are too cautious to say out loud, that during the challenge phase specifically, risking slightly more per trade is not reckless. It is rational. And we are going to show you exactly why. Welcome back to Trading Mind HQ. Let's get into it. The first thing to understand is that a prop firm challenge and a funded account are two completely different environments, and they should be traded differently. During the challenge, you have one objective: reach the profit target without breaching the drawdown limits. That is it. You are not managing a career. You are not protecting a salary. You paid a fee to attempt a challenge, and your job is to pass it as efficiently as possible. Once you are funded, the dynamic flips entirely. Now you are protecting a payout relationship. Every drawdown brings you closer to losing the account. Every consistent month builds confidence and increases your allocation over time. Preservation becomes the priority. This distinction matters because it directly informs how much risk you should be taking at each stage. And most traders make the mistake of treating both phases identically. They either risk too little during the challenge, grinding at 0.5% per trade and running out of patience before hitting the target, or they risk too much once funded, trading aggressively out of habit and blowing the account on a bad week. The framework we are going to give you today is built around that distinction. Here is the risk model we recommend for swing trading a prop firm challenge. During the challenge phase, risk 1.5% of the account per trade. Once funded, drop to 0.5% per trade. Let us look at why 1.5% makes sense during the challenge and why it is not as aggressive as it sounds. FTMO's standard challenge requires a 10% profit target with a maximum 10% total drawdown and a 5% daily loss limit. On a $100,000 account, that means you need to make $10,000 without losing more than $10,000 in total or $5,000 in a single day. At 1.5% risk per trade, a single losing trade costs you $1,500. To hit the daily loss limit in one day, you would need to lose more than 3 trades back-to-back, which a disciplined swing trader should never allow. One losing trade and you step back. You do not take 3 consecutive losses in one session when you are trading daily and H4 setups. Now look at the upside. Swing trading at a minimum 1 to 2 risk to reward means a winning trade returns 3% on the account. 5 winning trades at 1 to 2 RR, and some losses along the way, which is a very achievable sequence over 3 to 8 weeks of swing trading, gets you to 10% profit. Enough to pass the challenge. 1.5% gives you enough firepower to pass the challenge efficiently while keeping your daily loss exposure firmly within the rules. That is not reckless. That is calibrated. Once you are funded, the calculus changes. Drop to 0.5%. A single losing trade now costs less than 0.5% of the account. You can have a bad week and still be well within your drawdown limits. You give your edge time to play out without the account ever being in danger. And that consistency, month after month, is what can get your allocation increased. Now let us talk about which instruments work best for this approach and why. Because not all markets are created equal for swing trading a prop firm challenge. The first category is forex, specifically the major pairs: EUR/USD, GBP/USD, USD/JPY. These are the most liquid markets in the world, which means clean price action, reliable technical levels, and tight spreads. On the daily chart, these pairs form clear structural setups: higher highs and higher lows in uptrends, lower highs and lower lows in downtrends, that give you well-defined entry zones, obvious stop-loss placement below structure, and realistic targets at the next key level. Forex majors also have a significant advantage for prop firm challenges specifically. They are available on every platform, every firm supports them, and the spreads are essentially irrelevant. A few pips on a trade targeting 150 to 200 pips is nothing. The second category is indices. These are our preferred instruments for swing trading during a challenge for one specific reason. They trend. They respond to macro data, central bank decisions, and earnings cycles in predictable ways that a swing trader on a daily chart can position around. The third category is metals. Gold, specifically, XAU/USD. Gold is the swing trader's best friend during a prop firm challenge for a very simple reason. It moves. Gold regularly produces 1,500 to 3,000 pip daily ranges on significant sessions. A well-placed swing trade on gold with a clear structural stop and a 1 to 2 target can contribute 3% to the account in a single trade. No other instrument available on most prop firm platforms offers that combination of liquidity, volatility, and technical reliability. Our recommendation: use all three when your edge appears. When Forex majors are consolidating and not producing clean setups, gold or the DAX usually is. Rotating between the three means you are never forcing trades. You are always selecting from the cleanest setup available across three deep, liquid markets. Finally, the rules that hold this entire framework together. These are non-negotiable whether you are in the challenge phase or on a funded account. Rule 1. Only trade the daily and H4 timeframe. No exceptions. The moment you drop to a 15-minute chart to find a better entry, you are no longer swing trading. You are day trading with a wide stop, which is the worst of both worlds. Rule 2. Maximum 3 open trades at any time. 3 positions at 1.5% risk. Each means 4.5% of your account is exposed simultaneously. That is your absolute ceiling during the challenge. It keeps you well inside the daily loss limit, even if all 3 trades stop out on the same day. Rule 3. Never move your stop loss wider once a trade is placed. You defined your risk when you entered. The market does not care about your drawdown limit. If the setup was valid, the stop was valid. Let it play out. Rule 4. Once a trade is in 1-to-1 profit, meaning you are up the same amount you risked, move the stop to break even. You can no longer lose on that trade. This is how swing traders stay in the challenge for weeks without ever threatening the maximum drawdown. Rule 5. Take the weekend seriously. As a swing trader, you are allowed to hold over the weekend, but check your open positions on Friday afternoon. If a position is not yet at break-even and there is a major risk event over the weekend, consider closing it and re-entering Monday. Gap risk is real, and it is the one thing that can stop a swing trader out without warning. Follow these 5 rules consistently across Forex, indices, and metals, at 1.5% risk during the challenge and 0.5% once funded. And you have a framework that is structurally designed to keep you inside the prop firm rules while giving your edge enough room to produce results. That is the prop firm swing trading framework. 3 videos, 1 complete picture. The truth about how prop firms work, why swing trading gives you the structural edge, and the exact risk model and rules to execute it. If you have watched all 3 videos and found them useful, subscribe. We put out new trading education every week covering Forex, indices, metals, prop firms, and trading psychology. No hype, no noise. Links to videos 1 and 2 are in the description below if you missed them. See you in the next one.